Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Thursday, December 1st, 4:43 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we're continue to be in a bear market rally. I hope to be able to update this to uptrend tomorrow if the S&P 500 can get a weekly close above the 200-day / 40-week moving average. Nice test today of the 200-day that held and bounced, which is exactly what we want to see today. Really was a win for the bulls. So checking over here the trend gauge, leaders fine. Continuing to be green. In fact, they've been acting better than the indexes for a few weeks. Short-term, 21-day exponential moving average, green. That means all 5 of the major indexes that we track are trending above their short-term 21-day exponential moving average, also above their medium-term 50-day moving average. And long-term, I hope to be able to move this to neutral tomorrow. As I said, if the S&P can close above the 200-day moving average, and then we'll be on the lookout for the NASDAQ 100 being able to reclaim its 200-day moving average. That would get us bullish across all 3 time frames. A lot of people that keep seeing in their headlights a recession for next year are not happy at all with this market move up. And if you smell bear fur, that's them staying bearish in the face of bullish price action. We don't argue with the market. We follow what the market is telling us. And if the market can change on a dime tomorrow, we got a jobs report. We got some economic data today that really didn't make an impact at all after what Fed Chair Jerome Powell said yesterday in his speech and interview, and we're not going to argue with the action. Doesn't matter what we think. Price is the only thing that pays in the market. So what happened today? As I mentioned, healthy consolidation day, mixed numbers, but all in all, no red flags, not even a yellow flag, actually. I just put it in yellow because of the mixed numbers and to mean that it's neutral. But the G6 up just a fraction on the day. This is our 6 ETF growth proxy. S&P 500 battled between red and green all day after bouncing off the first test of the 200-day moving average. Ended up finishing down 0.09%. NASDAQ 100 up about 0.1%. Dow lagged as one of the big highly priced issues in their CRM, Salesforce, had a rough day, down 0.6%. Mid caps down 0.25%. Small caps down 0.25%. Global diversified 60/40 stock and bond up 0.38% as bonds. The price was up big, means the yields are down big, especially on the longer end, 30-year, 20-year, 10-year. GROTECTION in-house, we're up 0.06 on the day, despite one of our holdings being getting bludgeoned after announcing an offering. Luckily, it was only we had sized it down to 1% as we got stopped out on one of the buys. So minimal damage, but still not something I'm happy about. So let's get into the charts and a quick description of what we do at Revere. Risk management is our number 1 job here. We strive to protect clients' nest eggs from bear markets. And when the market is acting fine, we're fully committed to the market. When the market is acting badly, as it has been most of the day or most of the year, we've had a bear market, we protect capital. Maximum loss this year was about 11.5% versus negative 27.5% for the overall market. And our rules recently have been bringing us back into the market. So we've got buy rules, we've got sell rules. We're an SEC registered investment advisor, fee only, no conflicts. We have no products to sell you, just our strategies of protecting capital in bear markets and participating in bull markets. Prime example is last October, November, trending nicely above, and this was 2021, trending nicely above all of the 3 time frames that we track. That's The green line is the short-term 21-day. The red line is the medium-term 50-day. The black line is the critical 200-day moving average. Why is it so critical? Because every bear market has occurred under this level, the 200-day moving average, whether it be because of bad fiscal policy, because of bad geopolitical policy, inflation, war, financial crisis, tech bubble bursting. The business cycle is a real thing, and if you can dodge these major bullets, these are destroyers of capital. If you can keep the losses small, the gains will take care of themselves when the market rights itself. The average of these prior 6 bear markets down 44.5% means you need an 80% gain to get back to even. Even this most recently this year, down 27.5%, you need a 38% gain. Well, you say, well, I was diversified into bonds. Well, then you were down just as much because bonds have been taken to the woodshed up until the last month due to rising interest rates. So if you're interested in an approach like this, reach out to me. You can email don@revereasset.com. You can also email my partner and Revere President Danny Stewart, dan@revereasset.com, or call 855-REAL-WEALTH. That's 855-732-5932. We'd be happy to talk to you about your situation and what we can offer. So back to the S&P 500. You can see the big day yesterday. Jay Powell looking more dovish than he certainly did in the last FOMC meeting, where the statement was dovish, but he came out like a hawk and kicked the market down hard. You can see here the low of the day, 40.51, the 200-day moving average at 40.48. So back tested that and we held it and bounced. Let's look at a 5-minute chart. Pretty easy to see yesterday when Powell's speech was released. Big move to the upside, further move to the upside right out of the gate, and then a harsh 50.1% sell-off. But we bottomed there right before 10 o'clock, and then just a tight sideways move the rest of the day. This is just consolidation. Bulls and bears positioning themselves for what they see down the road. And the great thing is that 40.51 low held that pullback. Also, this little intraday consolidation was right at that 200-day moving average before we broke out later in the day. So anytime you back test a level, that means that it was resistance. It turns into support for the time being, and then you can see 2 higher lows made the rest of the day after we tested this 40.51. The next pullback was 40.59. The next one was 40.67, and actually another one here was even higher. So we'll see what tomorrow brings. Like I said, we got the jobs report, but I have a feeling that Jerome knew what the jobs report was showing, and he knew what the data that was coming out today was going to show, as it supported the case for easing back on interest rate hikes, and that's what his speech was about, and that's how he handled the Q&A. Let's go to the NASDAQ 100, the QQQ, the laggard of the 5 indexes, finished positive on the day. Nice reclaim and move up off of this 21-day moving average. That's the green line yesterday. You can see that we're still 3.9% below the 200-day moving average, but let's take a look at the equal weight NASDAQ 100, second close above the 200-day moving average and bounced at the 21-day moving average. This is again reinforcing that it's the big FANG stocks that are lagging and holding back because of the big tech presence in the S&P 500. It held back the S&P 500 and it's holding back the NASDAQ 100. Look at the equal weight S&P 500. A higher high and 1, 2, 3, 4, 5, 6, 7, 8 closes above the 200-day moving average. You can see the double bottom pattern with the 153 breakout will be there sooner than we'll be above the August highs in the S&P 500. And again, that's because of the heavy tech weighting of these FANG stocks at the top of the index, their market cap weighting. It didn't affect the Dow because the Dow is price weighted and has less tech, and certainly didn't impact, well, let's show the Dow very quickly. Dow lagged today, as I said, because of CRM, one of the higher priced, down 8.27%. It's $147 stock. So that was the laggard on the day for the Dow. The Dow Just bounced at the 80 MA, an inside day today. Anytime you can get an inside day after a big up move, remember the market only does one of three things. It trends up, it trends down, or it consolidates, and then preparing for the next trend higher or trend lower. An inside day after a big move is perfectly acceptable, and actually it's preferred because you don't want to get too far stretched to the upside. That leads to fear of missing out, and you start chasing, and then the inevitable pullback gets you shaken out. I still am tweaking my rules to keep me in and avoid getting shaken out. Every market is a little bit different. Rules that worked under one scenario don't necessarily work under another. We're constantly looking to improve here at Revere Asset. Here's mid caps. Moved to the new highs early and then pulled back again. This is totally acceptable. A consolidation day after a move up, and then small caps. Second close above the 200-day moving average, again tried to move higher, but pulled back after some FOMO at the open. No question about it. So let's take a look at the dollar now, and the dollar continues to slide. Down here at the 200-day moving average now, hasn't visited that the entire time that we can show this chart. So continued lower lows on the dollar is a tailwind for stocks. Let's take a look at the VIX. VIX broke 20 today, closed at 1992, getting into that area where we've seen prior bounces earlier this year. Will it be different this time? We never know, but we don't predict. We know that it will bounce at some point, and we are in oversold, and it is kind of stretched, but it's been trending. This is why we follow trends. It's been trending below this 21-day exponential moving average very consistently. Every time it got close to it, it came lower, kept making lower lows. That's the definition of a trend. Either higher highs and higher lows, or lower highs and lower lows. And it's behaving. That's about all I can say about it. Gold with the weak dollar, a great day, up 1.84%, now back above the 200-day moving average for the first time since June, making me look really dumb for selling my gold stocks 4 days ago. Gold, let's take a look at Bitcoin, BITO. This is a risk on asset, consolidated today after the move up yesterday, hanging right around that 16,000 area. Let's take a look at bonds, a broad bond index, BND, up today, continuing the trend higher after Powell's indication about slowing the rate of cuts. Bonds just continuing higher. Let's look at the TLT on a daily, making recent highs, trending nicely above this 8 EMA. You know what that means? It means yields are down. Let's look at the TYX, the 30-year yield, pulling back, making recent lows, very oversold. How about the 10-year, the TNX? Also making recent lows, very oversold, but showing no inclination to change course right now. So those are the major indexes that we wanted to take a look at. Let's go to the tail of the tape now, and then we'll take a look at our focus list of charts. So technicals are fine, despite the fact that we're oversold on bonds and on the dollar. I did not update sentiment. Give me a sec. And abracadabra, the power of the pause button. Put call 0.96, that's neutral. VIX under 20, fear and greed down 1 to 69. Operating under the bull case. Some news, PCE before the open. PCE core inflation was below estimate, 5% year over year. The Fed wants 2%. We're down to 5%, and we got a good reaction for it. Well, it is what it is. And then later, after the open, ISM manufacturing PMI showed contraction, which is bad news is good news scenario. Day count, we went from up 1 to up 1 with a consolidation day. Expectations positive as long as we hold the 200-day moving average now. Check. We tested and held it. Converted the resistance here to a support resistance level. We tested and held those. Tight range the most of the day after some chop early. Sectors that were good today, price of bonds up, that means yield in bonds down. Gold, silver, and gold and silver stocks, home builders, software, cybersecurity, and marijuana stocks. Apparently the Congress looking at pushing through a bill to ease up on federal marijuana. Bond yields down, dollar down, solar down, discount retail hammered today with an exception, and we bought the exception. And I'll talk about my logic with that buy. Semiconductors up, down, banks down, retail down. So here's our focus list. We'll go through those charts in a minute. Changes in-house today. So now that we're above the 200-day moving average, the more money we can get in at a low-risk entry on these leveraged ETFs, and if we hold and bounce and go higher, it's good for the portfolio. It's difficult for any stock that you buy to outperform a 3 times S&P 500. And if you can get your money in at a low-risk entry with a tight stop, because it should hold the 200-day moving average, and then the rest of the averages are catching up, they should provide support on any pullback also. It's a great risk reward, so we added the equivalent of 20% S&P 500 exposure today. As you know, I'm a big fan of the S&P 500, and the reason is all growth to value and all sector rotation takes place within the S&P 500. So sectors that are bad, money coming out of them one day, flowing into another one, it's all reflected in the weightings within the S&P 500. To get too far on one side of sectors, be it tech, be it energy, be it whatever, and you have a bad day there, your portfolio can really take a hit. We're all about smoothing the equity curve here at Revere, and this is one of the methods we use to do it. SHLS, this was the offering and the CEO resigning for health reasons, a double whammy. We took our loss on this. It was a 1% position. We sold it down about 15%, took a 0.15% hit to the portfolio. Our target for a 1% position is a 0.1, so we lost slightly more than we wanted to, but just waited for the intraday. And if you're trying to get out of something, one of the tips that I use is these stochastics, they're going to go to extremes intraday. As soon as it took this bounce to oversold, this is where I exited it near this 25 level. Luckily, it bottomed early, made this big rally, and this is where I exited. I mean, it's a broken stock now. It's not worth the mental capital. Tracking, even if it does bounce and hold at the 50-day moving average, I'm certain there are better opportunities than buying SH or continuing to hold SHLS there. Next thing that we bought, First Solar, bought it back. We sold it twice over the past week, up at 170 when it was extended, and then at 165 when it broke below the 80 MA. This is when the market was floundering a little bit before Powell spoke yesterday. Nice move yesterday on massive volume. This told me First Solar is absolutely still a leader, and then it started to pull back and have an inside day today on much lighter volume. The volume actually rallied at the end. It was closer to 50% below average. So when it came down and bounced at the 80 MA, I bought half the position back. We'll be looking to pyramid that 2% position at a continued low risk entry with the idea of avoiding getting any shakeout down to the 21-day exponential moving average. So we bought that. Now let's look at the discount retailers that got blown up today. Dollar General, gap down 7.5%, undercut, closed right near the 200-day moving average. This trickled over to Costco, down 6.5%, broke its 200-day moving average, and BJ's down 6%, broke all recent support. But then again, it did on its earnings day too, and big gaps down on earnings on volume or a sell signal anyway. But 5 reported earnings today, and let's take a look at an intraday chart on this. So it gapped up, huge volume. They have an above 5 new product, new line of goods that added to their bottom line. So you can see the gap up and it continued higher. Didn't want to buy because why? The stochastic was overbought. So when it started coming down, and sometimes it doesn't come down as low as it did, but it did. We bought about 184, 185-ish. It went a little bit lower down to 180, and then money came back in the rest of the day, pushing it just to a slight gain by the end of the day. So the fact that it has the N, which is one of my favorite letter in cancelim outside of the market, is the N in something new, and money flowing out of other discount retailers because of poor performance. Logic says it might flow into something that beat earnings expectations and forward guide. As you can see here, 25% earnings growth in the next fiscal year with a 39 PE. So the stock's trading at 187. It traded as much as 237 in 2021 when it only earned 211. Now it's going to earn 551. Tells me it's got room to go higher. If it continues to behave the way gaps up should, I'll be extremely pleased. Now, what I want it to do is I want it to act like these model gap ups and continuations that we've been seeing. I didn't bring this one up recently, but Starbucks did exactly what you wanted it to do too. Gap up, didn't break out on earnings, gentle pullbacks, broke the low of the gap up day, but didn't break the ADMA, and then started to trend higher, broke above within 5 days of the pivot, continued higher. Volume patterns are good. Gentle pullback, bounced off the ADMA, got up to the 100 area, natural resistance, pulled back gently to the ADMA again, and big volume coming in yesterday. I'm not in this, but you print this out because this is how you want them to act. And when they don't act like this, you sell them. And when they do, you let them run. And be mindful of the other ones the other two on earnings that I've been bragging about acting perfect. Elf didn't get the pullback, but you got the day two higher high. So sometimes you got to go with the momentum, and then its first pullback to the ADMA, you could have got in right around 50 or only a couple bucks higher than it was on the earnings gap up day. And now every pullback, one closed below the 8, the next day it came back above the 8 and then made a higher high today. This is the textbook look of what you want an earnings gap to do. And then the other one, SMCI, took a different way, but this is consistent with the different types of action that they have. Gapped out of the base, spent a couple of days inside the lower part of the base while the market was downtrending. You can see the black line underneath there very faintly. The market was pulling back, so that was holding back the stock. It came down right to the ADMA, held, continued higher, all pullbacks, holding the ADMA. Shakeout yesterday. If you survived it, great. And then reclaimed it today, pulled back, closed in the lower part of the range, perfectly acceptable, still above the ADMA. This is how you want them to act after you get an earnings gap. There's a couple of different flavors of them, but the ADMA is the key level that I use, and then you compare the volume versus the price, and let it do its thing if it's going to do its thing. So we added 5. We added First Solar. We sold SHLS, and we added to the S&P. So that brought our adjusted beta up to 0.99. So basically in line with the S&P 500, which has a 1.0 beta. And the bottom line for today, S&P 500 tests and holds the 200-day moving average. Nice consolidation day. We'll see what the reaction to the jobs report brings tomorrow. Now let's go through our focus list. I already showed 5. I already showed First Solar. Dexcom was another one I was looking at very closely today. Gentle pullback on volume. One closed below the 21. Shot back above it yesterday and a higher high today. This again is, I'd give it a B as opposed to the A. As far the 3 examples that I just gave that were acting like A's, but this one pulled back and held the 21, not quite as good, but also held the low of the gap up day. So if you were a little bit patient with this one, you're getting rewarded. So Dexcom, SANM, this was another gap, and another one that's acting just fine. One undercut of the 8, and then 2 closes below it, but held the 21. That was with a little bit of a shaky market Monday and Tuesday, and then reasserting itself yesterday and today with volume, and especially look at the volume on the sell-off versus the volume the last 2 days. That's textbook accumulation. So that's a pretty good version of accumulation, and I want to put that in my folder of proper acting gaps. So SANM, ANET was another one. I continue to look closely at this. Should have bought it yesterday if I was going to. Now it's got away from me a little bit here, so a little bit extended today. So unlikely to take action on that one. IBKR. This was basically a failure with this harsh break below the 21. Again, here's the same playbook. Gap up on earnings, riding the 80 MA higher. When it gets below the 8, your first sign of possible trouble. This was sold off hard on 11/11. That was the day after the CPI report, when all of the quote-unquote safe growth stocks got sold off and money flowed into more risky ones. Now, it recovered since then, got back up to the top of the handle, and then a shake today down to the 21. This is a little bit more activity in the handle than I would like to see, but I prefer Schwab versus this one. Same group, this one acting certainly gentler, let's say. Undercut, put in the bottom on its earnings day, and then it starts riding the 80 MA higher. Gets up to the top of the range. This is a variation on that. You didn't get the gap up, you got the gap down. That got rid of all of the weak hands, and it put in the low for the most recent period and started heading higher. Consolidation into the handle, 2 undercuts and reclaim of the 21. Attempt to break out, not quite ready yet. Nice volume yesterday, inside day today. So Schwab looking pretty good to me. Pure Storage, Michael's done a lot of research on this and he owns it. Ugly shakeout yesterday prior to their earnings after the close, but did close at the top of the range, and then a good reaction to earnings today, getting it back above the 21-day exponential moving average. You can see the stochastic has completely reset from overbought to oversold, so it's set up for higher prices. One I took a very close look at today, but decided not to buy after the other two buys that we made. Wingstop, this is another one. This is, it acted great after its earnings gap, undercut the 8, reclaimed it, never closed below the 8, higher high, but then kind of a difficult pullback, even though it's on light volume. Price is all that pays. I know the volume's doing what you wanted it to, but it should have held the 21 here. Break below the 21 and then another shakeout, but a shakeout down to the 150 level. You got to look at these scenarios and see what's possible to see if you can stay in the stock, and very often just selling half and sizing down and giving it a chance, because there's massive support here at 150, which is below the 21. I don't like to hold things below the 21, but it bounced there, and then perfect action yesterday back above the 21 and closing at the top of the range today. Good action there on Wing. Palo Alto Networks. Their security stocks need to be owned in big institutional portfolios, and they've been acting like garbage lately. This is one that's not acting like garbage. This put in a bottom on its earnings, gapped up the next day. Hard shakeout here, but this was because of the CrowdStrike earnings report. When one of these has a bad earnings, it hits all of them, but it finished the day at the top of the range and then blasted through the 200-day moving average today. I'm keeping an eye on this one. It's not one of the best setups, but it goes on my list to watch. Still has some work to do to get back to the top of its range. But compare that, the big three in this space used to be CrowdStrike, Zscaler, and Palo Alto. CrowdStrike rebounded a bit yesterday after being down, or today after being down 50% yesterday on earnings, and Zscaler reported after the close. And initially it was down double digits. Let me see if I can get a quote on it here. Yeah, it's still down 10% after hours. So maybe that Pan W is the survivor from that group. And we always want to show Apple just to see what it's doing. Nice digestion day, held the 50 and the 21, so that's good stuff for the overall market. And then we already showed ELF, SMCI, and AEHR, as that's the one that shook me out and continues to act great, but I'm not bitter. Anyway, that's going to wrap it. As always, like to hear from you. Email is don@revereasset.com. Comments, questions, complaints, bring them on. The pink cursor is here because of a comment from somebody that said they couldn't follow my cursor, and I certainly understand, and I like the pink cursor better too myself. So yeah, we listen to what you say. So if you got something to say, speak up. So wrapping up. First day of December, first trading day of December. Let's see, big day tomorrow. Let's see the reaction to the jobs report and if the S&P 500 can hold this key 200-day moving average long-term trend line. Remember, in the markets, it's not how much you make, it's how much you keep. All the capital that we preserve during this 3 legs down, we're trying to get back to the positive side for the year. Would be very nice. It would take a hell of a December to do that. Probably not likely, but you never know. So wrapping up 12-1, this is Don Vandenbord telling it like it is. Thanks for listening and have a great day.